Finally, we've been discussing these market indices, market averages since the beginning of the semester. We're finally now going to define what they are, where they come from, what's going on with these things. So let's get started on slide 47 with market averages and market indexes. Indices is another word for the plural of index. How can we say that stocks have returned approximately 10% over the past 90 years? Well, the industry uses market averages and indexes. They are benchmarks, standards, measures of how well we've done. These benchmarks are used to measure the general behavior of securities prices, in this case stocks, by reflecting either the average price behavior, and that's a market average, or a relational price behavior, that's a market index, of representative groups of securities at any given point in time. Now, again, we're using the word securities, which means also bonds and other financial investments, but in this chapter, we're concentrating on stocks. And you can't help but hear about these things every day in the news. The Dow went down, the Nasdaq went up, what are they? Plus, what's the difference between a market average and a market index? The differences are subtle, and we're just going to not do any of the calculations. We're just going to take into account the fact that the index doesn't just look at the price, it also looks at the value of the company, what's called the capitalization. Whereas the averages just look at the price. And most people don't even know there's a difference, and it really doesn't matter because there are only a few averages that are still used and are reported in the media. So this slide on 48 tries to discuss the difference, whereas share price calculation is how we use the market average. You look solely at the price without regard to how big the company is. And the big one for that, the most important one, is the Dow Jones Industrial Average. Whereas all the other benchmarks, all the other measures that we use are market weighted. They are market indexes. They take into account the price times the number of shares outstanding. So the larger the company, the more influence the security, the stock, will have in the index. Does that make any sense? In other words, the big companies are going to push the index up or down higher than the smaller companies. And the big example of this is the one we've been discussing all semester, Standard & Poor's 500 stock index. It's certainly the most popular index. Market-weighted calculations were generally regarded as a better measure until they weren't. Until some very large companies started to skew the index in a way that basically masked how the entire index was doing. And we discussed this in chapter 2 quickly when we talked about index funds. And what we see now is that it's even stronger. The influence of the largest companies is even stronger than it was back in the late 90s. So there's some of you might have done it. There's a bonus assignment in chapter 2 that asks you to take a look at the top 10. You actually have to look at the top 11 because one company is in there twice. What influence those top 10 companies have on an index where there are 500 companies in the index. And it's a bit of an eye-opener. So we hope you do that. It'll take you all of 10 minutes, folks. And it's worth 2 points. So there are market averages and market indexes. The differences between the two are subtle. You don't really have to worry about that too much, other than to know that sometimes indexes can get skewed out of proportion. And one of those times is, in my humble opinion, right now. Slide 49. The granddaddy of them all was the Dow Jones Industrial Average. It's an average, which means it's share price calculation. You don't worry about how big the company is. Made up of 30 high-quality stocks selected for total market value and broad public ownership, and believed to reflect overall market activity. Don't you believe it? It's not true. First of all, it's only 30 companies. It started in 1896 with 12 companies and then went up to 20, and was started by Charles Dow. You might have heard of Dow Jones. They're the company that publishes the Wall Street Journal, and they are now owned by Fox News. So figure that one out. They change from time to time as companies and industries evolved. And so they really shouldn't even call it the industrial average anymore, because it has more non-industrial stocks than it has industrial stocks. And for decades, for over 100 years, Dow Jones, the Wall Street Journal, was run by a private family, the Bancrofts. And Rupert Murdoch, of Who Wants to Own Everything. He's not the only one, but he came knocking on their door and offered them almost 100% more than what it was worth. Everyone believed, or the general belief was, that the private company Dow Jones was worth about $3 billion. He offered them $5 billion. And some in the family did not want to sell to Fox News. And some of the others said, do you see what he's offering us? So they wound up selling, and now it's owned by Fox. But it appears that Fox has sold, or at least there's something going on, or has licensed the Dow Jones Industrial Average and their other indices and market averages to the Standard & Poor's 500 company, which does the Standard & Poor's 500. I can't figure it out. If you can get into S&P Global, spglobal.com, and figure out what the relationship is, that would be great, because I'd really like to know. But it looks as though they basically said, well, we're not interested in doing this, but we want to keep the name out there because it's, it's brand recognition and the like. So it looks like Standard & Poor's is actually the one who's running the Dow Jones Industrial Average now. Is that confusing enough for you? And here they are, folks. Here are the 30 Dow stocks as of this presentation. And as we said, it changes over time. And yeah, they just kicked out last year 3 companies that were in the Dow for quite some time. Walgreens, Boots Alliance. Who'd they put in there for them? Oh, they put in Amazon for them. They kicked out Intel, of all people, and put in Nvidia. And then they kicked out Dow Chemical, which has no relationship with Dow Jones, Dow Chemical, and put in Sherwin-Williams, a paint company. I don't know. Sherwin-Williams is actually pretty darn popular in Mexico. Wherever you go in Mexico, you see Sherwin-Williams. But most of these companies you've heard of, right? American Excuse, Amgen. Wait a minute. Who's Amgen? They're a biotech company. Apple, Boeing, right? They make the planes that fall out of the sky lately. Caterpillar, it makes the earth-moving equipment. Chevron, Cisco Networking, Coca-Cola, Disney, Goldman Sachs, Government Sachs. They're not a bank, like as we know banks. They're an investment bank, which they're the people who help companies go public, right, and sell their bonds. Home Depot, Honeywell, yeah, you've used their products. In fact, when you turn the heat up or turn the air conditioning up, you're using probably Honeywell's equipment. IBM, I'm surprised they're still allowed IBM in there, because they've been hitting on harder and harder times. Johnson & Johnson, been around for over 150 years. JP Morgan Chase, A Bank, plus a lot of other things they do. McDonald, they're also an investment banker too, but they're also obviously I think they're the nation's largest bank. Yeah. McDonald's, Merck is a pharmaceutical companies, Microsoft, Nike, there's Nvidia, Procter and Gamble. Who are they? Soap, toothpaste, Pampers, yeah, diapers, consumer products. Salesforce, and supposedly it's lowercase, but I don't want to do that. Their customer something or other management or something like that, resource management. We use them, and I don't think it's a very good system, but hey, I do what I'm told. Sherwin-Williams, the paint. 3M, who are they? 3M, Minnesota Mining and Materials, Post-it notes, Scotch tape, Travelers Insurance, United Healthcare Insurance, Verizon, Visa, and Walmart. So now, in the face-to-face class, we would pass out a little handout called 90 Years Ago. And we want you to do it. It's a lot of fun. It's not real money. We're going to give you $10,000 and see how you did by picking one stock. But wait a minute. Nike, Microsoft, they weren't around 90 years ago. So you would have bought the stock that they replaced. So check it out. It's on the website in Canvas. It's cute. And then there are many other Dow Jones averages and indexes. The transport average is one that many people watch because it sees what's going on with the transportation companies, and people use the transport companies as a leading indicator because before the stuff can be built, the raw materials have to get to where they're processed, and then the finished products have to get to where they're sold. So they watch the transport average. The utilities, pretty boring because the utilities are pretty boring. And then you put together the industrial average, the transport average, and the utilities average, and you get this 65 stocks composite average. Those three, you might hear a little bit about the transport average, but those first three. Now, you're not going to hear too much about the first three. But this fourth one, oh yeah, the U.S. Total Stock Market Index, and then the U.S. Completion Total Stock Market Index. I still call them by their old names, the Wilshire 5000, the Wilshire 4500. What did they do? Right, they were used, well, at least the U.S. Completion, the 4500, was used in the TSP. So you did a little bit of research on that. The 5,000 are 5,000 of the companies in the United States, meaning the large cap, the big companies, the small companies, and the medium size. And then the 4,500 takes away the top 500 companies to give you the medium size and the small size companies. The Dow Jones Internet Index is an example of how silly and ridiculous our industry can be. The Dow Jones Internet Index came out, of course, when the internet was, some of you weren't even born yet, but was the thing. The world is changing and its productivity gains as far as the eye can see. Blue skies, we're all going to get rich, rich, rich. And then promptly fell 96%. Yeah, and all those companies are gone. Now the Internet Index is made up of newer companies, which have actually done pretty darn well. So those were the Dow. The only one you really have to remember, the only two you have to remember is the Dow Jones Industrial Average, which I don't really think is a very good one, but it's what you're going to hear. And then the 4,500, the completion or extended, or it goes by various names. I wish I just kept the Wilshire 4,500. Because here we are on slide 52, which I believe is the most important one, but even that has problems. And that's the Standard & Poor's 500, the S&P, the S&P 500. These are 500 of the largest companies chosen for market size, liquidity, and industry group representation. As we said, it is market value weighted. The larger companies have more sway, have more influence. It's the most popular index fund out there. And because it is market weighted, it has been affected by it was affected by the internet bubble of the late 1990s in a bizarre manner. The market values of a small percentage of technology companies were inflated to extremes. This skewed the index even more toward those companies. In 1998, 10% of the gain in the S&P 500 was due to one stock. That was Microsoft. Does this sound familiar? The same phenomenon is currently in play with the top 10 companies having an outsized influence on the index. And there's a couple of little things I want you to take a look at. If you if you haven't done it already, the bonus assignment for Chapter 2. I mean, these companies have just gotten to the point where most of them, some of them are the big ones. You know I'm talking about: Amazon, Apple, Nvidia, Tesla was up there. Now they're down. They're coming back up. Nvidia, who else? These companies, they're worth more than the gross domestic product of most all the nations in the world. And so I'm not trying to disparage them at all. They're brutal and strong competitors. But I just believe that things have gotten out of whack. And now we hear that, they're going to go 10 times more than they are, though. They'll be worth $30 trillion. That's just really hard to believe, but, we'll see. That's why they call it the future. But I ain't holding my breath. Now, S&P has literally thousands. I have a hard time believing this, but they have thousands of these indices. The industrial 400, the mid-cap 400, the small-cap 600. You put the S&P 500 index, the mid-cap and the small-cap together, you get the 1500 index. Transportation, utilities, financials, global, international, sector indices. Which is the one you have to remember? The S&P 500. But check out spglobal.com. I think that's what it says when you go underneath it, right? Oh, it does. Yeah, it says spglobal.com ratings. And see if you can figure out the relationship with Dow Jones Industrial Average and S&P. I couldn't figure it out. I think they must have licensed it or something. Okay, now, there are a few that you may hear about every once in a while. The New York Stock Exchange Composite Index, the Amex, remember the New York Stock Exchange American? But the next one, number 3, you're going to hear in the news pretty much every day, the NASDAQ. And remember, NASDAQ stood for National Association of Securities Dealers Automated Quotation System, but nobody wants you to remember that. They just want you to remember them as the NASDAQ. And it's all uppercase, which I hate. But that's the way they write it out, so I do what they tell me to do. This is quoted in the news almost every day. Why? Because it represents the tech sector. Well, there are some companies that are really not, technology companies. I mean, is Starbucks, I think they're still in the NASDAQ. Costco, I don't know. But this one's important because these are where the huge companies are. The companies worth $3 trillion. So watch that. And then there's a NASDAQ 100 index, which you don't hear too much about. 100 of the non-financial firms. The NASDAQ composite went from 800 in 1995 to 2,000. I'm sorry, to 5,200. I mean, it just went in 3 directions. Up, way up, and way, way up. And then subsequently lost 80% of its value between March of 2000 to October 2022 before starting to recover. And people say, well, the NASDAQ didn't recover until whatever it was, 2011 or 12. I forget what. But it wasn't the same index. This is what we want you to understand. These things are not very good, in my humble opinion, but it's all we got. Because those companies that made up the NASDAQ in 1998, 1999, AOL Online, CMGI, drcoop.com, the Globe.com, all these companies with .com at the Amazon.com, which survived, many of them are gone. They're gone, and then new companies came and took their place. So these indices are not static. They change over time. And so when people say, well, it's not what it was 20 years ago, you say, you're darn right. It's an entirely different index. Okay? So far, what do we got? To remember, the Dow, S&P 500, Wilshire 4500, Dow Jones Completion, U.S. stock market, whatever it is, and then the NASDAQ. So that's 4 so far. All right, let's add, well, we're just going to review here. Here is the discussion between the Dow. I apologize. I still call it the Wilshire 5000 because Wilshire is another one of these companies that does research. And so Dow Jones made a deal with them, and they called it the Dow Jones Wilshire 5000. And then they kicked them out the door, and then they called it the Dow Jones U.S. Total Stock Market Index. And of course, S&P and this other company called MSCI, which we'll get to in a bit, Morgan Stanley Capital International. They've got their own total stock market indices, but the Dow is the one that you see the most of. And then the Dow Jones U.S. Completion Total Stock Market Index. Who makes up these names? They're making more money than I do, that's for sure. But I still call it the Wilshire 4500. So remember, this one, the TSP, right? That's the that was the S fund that you researched. So remember this one right here, the 4500. And you can call it the Wilshire 4500, and you'll make your professor happy because I can't remember Dow Jones U.S. Completion Total Stock Market Index. I just can't remember it. I apologize. Now, there's another one that's pretty important, and that's the Russell 2000. You'll hear about it every once in a while. Frank Russell Associates is another one of these companies that does market research, and they were the first to create an index that was just designed to measure small companies. Just designed to measure small companies. And so what did they do? They took the top 3,000 companies by size, and then they cut off the first 1,000. So they're the Russell 1,000, top 1,000 companies. And then they took the top 3,000 and they kicked out the top 1,000. So what's left over is 1,001 to 3,000, right? The companies from 1,001 all the way to 3,000. And the idea was we want to see what's going on in small companies, in medium-sized companies. So this is the most popular measure for small companies. You'll see, how's the Russell doing? Well, my goodness, you see, the big companies are kind of failing, but the small companies are doing really well, or vice versa. So you'll see that in the news every once in a while, especially if you go to the Yahoo Finance and the other finance websites. Now, there are two other indices that are changing that are important. And they are indices that tell us what's going on outside the United States. There's a company called Capital Group now. They started out Capital Research and Management. Now they call themselves Capital Group. They're often referred to as the American funds. And they've been around for over 90 years. What they did is they started investing early with a few other companies, Templeton and T. Rowe Price, globally. But there really weren't any indices to measure how well you were doing or how well the global market was doing. So they created two. They created the World Index and the EFA. And then sometimes you'll hear people say it EFI. The World Index was designed to measure how the global developed market was doing. And the EFI or EFA was designed to see how well everybody except for the United States. Remember, international? Right. Everybody except for the United States. And the problem was they were measuring themselves against the benchmark that they were creating. Yeah, not a good idea, right? For credibility. So what they did is they spun it off and sold it to Morgan Stanley. So you don't have to remember this unless you want to trivia bar. You're at a bar and you want to have a bet at a bar for trivia. MSCI stands for Morgan Stanley Capital International. And so they had the World and the EFA, or the EFI index. And that was great, right? Well, instead of just expanding the World Index and the EFI index or the EFA index to include the developing world, they created two new indices. The MSCI All Country World Index, which is replacing the World Index because it's including Mexico and Brazil and Eastern Europe and Africa and the Southern Asia and China and Philippines. And oh, by the way, EFI stands for Europe, Australia, and the Far East. So it was Europe. It was interesting. Canada was part of the EFA. I would think you'd want to keep Canada and the United States together, but no. So South Africa, Australia, Japan, Singapore, Hong Kong, and Western Europe. But then the EFI is being replaced now by the All Country World ex-USA Index. Again, who makes up these names? I didn't. And I wish I were getting paid as well as these people who are making up these names. So now there are three more for you to remember. The Russell 2000, the World Index, which is being replaced by the All Country World Index, and the EFA, which is being replaced by the All Country World ex-USA Index, or whatever. So those are the 8 out of thousands that you need to remember. And of course, we have a worksheet that we would pass out right now in the face-to-face class, and you're going to do it on your own. And there's a commentary and an answer key. So we want you to memorize these 8 indices, okay? Because no one's going to memorize hundreds or thousands of the darn things. But we want you to know these important 8 indexes. Okay, enough. 5:57. This is what you're going to see on the nightly news, nightly business report, the Infernal Net, whatever. Oh, today, the stock market index mania, our today's unstable stock market, the Dow, started at 44,740 and then rocketed throughout the morning to peak at 44,750 and then plunged in the afternoon, trading down to 44,725 and ended the day pretty much where it started. You know, there's a wonderful book that was written in the 1950s, which of course all the numbers are way off. But it's called How to Lie with Statistics. And one of the things that people do when they lie with statistics is they don't show you the whole picture. They're only showing you between 44,750 and 725 and 44,750, which makes it look like a real roller coaster. But what if they showed you the origin? If they showed you way all the way to the bottom from zero all the way to the top, this is what they would put on the nightly news. Like, not too exciting, isn't it? In fact, we have stock market index ennui. Isn't that a wonderful word, ennui? It's a French word, but it's also English. It means beyond boredom, ennui. Yeah. They won't sell many newspapers or eyeballs for their internet website or the television show if they showed you this graph. Right. So you're not going to see this graph. But this is what we want you to think of. We want to forget what's going on day to day to day. Think about long term. And so now what we're going to do, and this next slide is one of my favorite slides all this semester when we teach face to face, because I love to watch people's faces. And that's slide 59. The volatility that we saw a couple of presentations ago, remember that, for 2024? Well, here is the boring version that you will not see on the nightly news. This shows you from 0 to 12,000, whatever it was, 450 or something like that. And so when you see it in this graph, it doesn't look as scary, does it? In fact, one of the most exciting parts of my job here when I teach face-to-face is to watch people's faces when they see this graph. And you can see some of them just start to relax, because a lot of people are worried about investing in the stock market. You should be. It's not without its problems, and one of the problems is volatility. But when you look at it at a long-term basis and realize that the bumps and grinds are not that big a deal, you kind of go, okay, I can live with this. In fact, one of my clients many years ago had just put $50 a month for 2 months, and the market had its downturn. This was back in 2000 to 2002, and she called me up and said, Frank, the market's down. What should we do? I said, nothing, well, I lost some money. I said, well, look at your statement. How much did you lose? It had gone from about $100 down to $98. And she goes, $2. I said, how's it feel to lose $2? She goes, not bad. So, yeah, as we've said, if the whole thing cracks and dissolves and we're all destitute, it doesn't matter. It doesn't matter. I'm optimistic economically. Cool. Now, go back over this material, study that worksheet number 1, because we're going to ask you on the test. But more importantly, you're going to be the investment guru. You're rising gurus now. You're going to be an official investment guru after chapter 4. And it's important that you understand it and explain to people that, just turn off the television, turn off the radio, put your phone away, or go play some game or something like that. What's it going to be like in 5, 10, 20 years? I think it's going to be a lot better. Well, we'll see. Cool. Thank you so much for being in our class. Are you getting an education? I certainly hope so. See you in our next presentation, dear students. Thank you again for being in our class. We are so proud of you.